Hey there, this is Prof. Aram, and in this video, I'm going to go over 5 basic principles of finance. When you start learning finance, you may see it as a set of isolated decision rules, which cannot be further from truth. In fact, these decision rules and their underlying logic have roots in 5 principles that are common sense, and you do not need a knowledge of finance to understand them. These fundamental principles are a roadmap to creating value in any business. As I mentioned, you do not need a knowledge of finance to understand these principles, but it is crucial to understand these principles in order to understand finance. Most of these laws and principles that we are going to talk about in finance are just common sense. Everybody knows them. However, what we are going to do in this class and others is to provide a framework for each and teach you techniques to apply them to both simple and complex settings. For example, the first one, time value of money, right? That means a dollar received today is worth more than a dollar received in the future. We can invest the dollar received today to earn interest. And therefore, in the future, we will have more than $1 as we have earned interest on the investment. The second one is the risk-return trade-off. Investors are usually risk-averse and prefer certain returns to uncertain returns. So if you want them to take risk by investing in your company, they expect to be compensated with additional return. And the higher the risk in an investment, the higher the expected return that they demand, right? The third one is cash flow is the king, right? So profits or net income is an accounting concept and measures a business's performance. But cash flow, on the other hand, is the amount of cash that can be taken out of the business, right? Companies' profits can significantly differ from its cash flows, right? In fact, it is possible for a company to report profits without generating cash, or it is possible that a company reports negative profits or losses, but the company actually generates a lot of cash flows, right? So both scenarios are quite possible to happen. So cash is the king. The fourth principle is market prices reflect information. Investors usually respond to new information by buying and selling securities. The speed of investor reaction and the speed of price adjustment determines the efficiency of the market, right? In fact, in the future, I'm going to have a video that goes over the efficient market hypothesis and basically measuring how efficient a particular market is. For example, how efficient the stock market is, how efficient is the bond market, how efficient is the derivative market. You can basically measure all of those, which basically, the efficiency is the speed, right, of investor reaction or price adjustment in the market. For example, if the company releases some good news, you can see immediately the price of the stock is going up. Or if the company releases bad news, of course, you see that the stock prices are going to be lower after the announcement, right? And the last one is individuals respond to incentives. Managers, as agents, respond to incentives they are given in the workplace. If the incentives are not properly aligned with those of the firm's shareholders or the owners of the firm, they may not make decisions that are consistent with the increasing shareholder value, which of course leads to agency costs and agency issues. So these are the 5 principles of finance. I hope you find this video useful, and thanks for watching.